Well, good morning, everybody. Welcome to the November 22nd meeting of the Town of Merrimack Trustees of Trust Funds. I'm Chris Christensen. To my right, we have,
Bill Wilkes, trustee.
Kathy Schur, alternate.
and to my left,
Liz Petrody, trustee.
Paul Calabria, Finance Director.
thank you all. And in the audience, if you want to make sure your microphone is turned on with a green light and introduce yourselves.
Oh, we're not on the air.
Lindsay Donovan, Cambridge Trust Company.
Welcome, Lindsay.
Eric Jusom, Cambridge Trust.
Welcome, Eric.
And Lisa Toronto, Cambridge Trust.
Hi, Lisa. Thank you for coming. First order of business, minutes of October 18th. Do we have a motion?
I will make a motion to approve the minutes of October 18th.
I'll second.
Any comments, corrections, discussion, omissions?
Just wanted to clarify one, there was an item in there, there was a discussion on the previous, it said 2019, there was a review of whether or not we should address a cutting at that time due to COVID, but that
Yeah.
2019 would have been just prior to COVID, so just if
It was
people are looking,
October, it was October 7th, 2019.
so it started pre-COVID.
Right.
Okay, all right. So if we go back to the notes, it's still there, or the minutes. Because I remember coming in 2020, I thought.
Yeah.
Okay.
Okay. So that is correct.
Okay. Yep.
October 2019.
Good.
Anything else? All in favor signify by saying aye.
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 300. Next order of business is portfolio review with Cambridge Trust. Who's first?
I will start first and talk a little bit about the markets, and then hand it off to Lindsay to talk more about the performance of the individual portfolios.
Can you
So-
see that up here?
No.
Okay. You got it on your laptop?
We have it on the left, and we have pages
Okay.
as well. So obviously this year. Oh, here we go. Thank you. So far this year, it's been a really strong year for the stock markets. Through yesterday, the S&P was up about 24%. What we've seen happen is a little bit of a little more of a broader base return to the markets that we saw the first half of this year, where not so much Mag 7 related, especially post-election, we had a little bit of a selling off of some of the Mag 7 names. More value came into the market. So it's been more of a broad-based rally. Valuations, if you look at the S&P as a whole, are pretty expensive, trading 23, 24 times earnings. But if you look at the equal weighted index, it's trading about 17 times earnings. So that leads us to believe there's still, the market, it's very frothy at the top, but the remaining 490 stocks are not as expensive as the broad market. So there's still opportunities we think for stock returns to be positive into 2025. The Fed has lowered interest rates 75 basis points so far this year. Expectations, we could see another 4 cuts into 2025, which we think may be overly optimistic. Again, with the change in leadership in Washington, D.C., you have one-party control and more of a pro-growth, America First agenda. You could see at the same time the Fed is trying to increase stimulus via rate cuts, that you could have more stimulus coming in and more growth coming into the market, which could lead to inflation. Especially the tariff talk could lead to higher inflation into 2025 as well. So we think interest rates, probably the Fed, I believe Powell at his recent commentary indicated it's more of a wait and hold. They might be on pause. Several members have come out and indicated it's not full throttle to continue to reduce rates. So again, 75 basis points of rate cuts so far this year. They do have a meeting in December, and the polling odds, or if you look at the Fed futures market right now, it's about a 50% chance that they move another 25 basis points. That's down substantially from the election. So the market is now, if you look at the long end of the yield curve, especially look at the 10-year Treasury, has increased its yield to about 4.4%. And that increase is not because of inflation, it's because of growth. So you're actually starting to see real yields are increasing, which can be restrictive as well. So at the same time, the Fed has to be very concerned about that second wave of inflation. So far, they've been able to orchestrate what is called a soft landing. So take inflation, which, much progress has been made on inflation, and you can see on the chart here. So one of the themes we're looking at into 2025, the full investment team, of inflation cooling, you have a slowing economy and employment. So everything is starting to cool at the same time, which is what the Fed tried to orchestrate, with the raise in interest rates, and now starting to cut interest rates to keep the economy afloat. The economy continues to do very well. Consumer spending remains strong. Retail sales are strong. GDP growth for third quarter this year is about 2.8%. Inflation running at 3%. So the economy doesn't really need more stimulus, maybe rate cuts. And if you have a pro-growth agenda coming in from the new administration, it could lead to a second wave of inflation. And history has shown that second wave inflation tends to be worse than the first wave. So that's something that our team is looking at as we move into 2025. But overall, it's been a really strong year for the markets. Your portfolios have done very, very well, especially against the income-focused benchmark. A lot of outperformance, a couple hundred basis points of outperformance versus those benchmarks. If you want to turn to the next slide. Portfolio yields have decreased, mostly related to the equities, and that's just basically due to the growth of the stock market. So as the appreciation has happened in the stocks, the yields have come down a little bit in some of those portfolios. But overall, yields remain very attractive, especially looking at bond yields are in the mid 4.5% area, substantially higher than when they were, 4 years ago when we were struggling to get the 2.5% yield. So I think overall, where we are in the business cycle right now, we were going late cycle, and recently we've seen more mid-cycle type of returns coming from the market, which is good because the market is not fixated right now on a recession. So recession talk is off the table, at least near term, and that's one of the reasons. I know there's a question ahead of time. We added a mid-cap fund to the income portfolio, and the reason for that was to look at more mid-cycle type coming down in cap structure where we have more, we can add growth to that portfolio, and we felt that was a good opportunity. And since that initiation of that position back in early August, it's actually outperformed. You look at the Russell 1000, the Russell 3000, it's outperformed the NASDAQ as well as the S&P 500. So as I was saying earlier, you see more broad-based returns coming from the other 490 type stocks in the S&P 500. So the reason why we added that is to take advantage of an attractive opportunity and come down a little bit in cap structure. We only did that for the income portfolio, excluded the principal, where that's more of an income payout, where income portfolio has more of a longer term, can have more growth, can have capital gains paid out into the fund, into the portfolio. So with that, heading into 2025, we're very cognizant of, the valuations of the market as a whole, but there's still areas of growth. We do have a pretty good position right now in financials, which are benefiting right now from the steepness of the yield curve. Again, we've had last several years, we had an inverted yield curve. This year, especially when we went towards July and August, the yield curve started to steepen ahead of the Fed rate cut. So now you have it's still not the steepest yield curve we've ever had, but it's not inverted. So we usually get the yield differential between the 2-year and the 10-year Treasury. That's about 16 basis points. So it's steeper than where it has been. Anticipation, if we see more growth coming into the market, that the long end of the yield curve could continue to move higher as short rates probably stay more anchored, viewed more around, the activity of the Fed and potential rate cuts or pauses. So finance has been a very good sector for the market this year, and we expect that to continue. As deregulation is probably going to be at least right now, it looks like it's going to be a focal point for the new administration of more deregulation. And again, we've already had a Trump presidency. We kind of know what type of investments did very well during that time period, and those are areas we're looking at right now. Not making any dramatic changes to the portfolio. Trading activity has been very low this year, as we've sort of let the winners win, and I should say that the stocks that have done very well continue to run. And we're cognizant of valuations, but right now we're very comfortable, and we think based on historical trends, what we've seen in the past, that the soft landing, not an ultra aggressive Fed, has typically portrayed to strong stock returns, and we anticipate that to continue into 2025. Probably not the mid-20 type returns that we've seen this year, but kind of reverting back to the mean, low to mid-high single digits or low teen type returns expected for next year. And with that, happy to answer any questions on the markets and the economy. Otherwise, I'll turn it over to Lindsay to talk a little bit more about the portfolio returns.
Okay, very good, thank you. Anybody? I have a couple of questions.
Sure.
Actually, I think some of them are for Lindsay, so I'll hold that. But in terms of improved earnings, are companies, because of volatility, more likely to hang on to those earnings? Are we gonna see some dividend increases? As a global question.
I think you'll probably see dividend increases. Earnings estimates are still 2025 looking 11 to 13%, so still looking at positive earnings growth next year. The companies have, especially some of the stocks that we have owned, have continued to increase their dividends. However, just, you look at AT&T is up 42% this year, so that dividend yield has decreased, just due to the math of the higher market value has decreased the dividend yield. But, it's still, paying, a sizable dividend. So we anticipate certain sectors to continue to increase, especially in financials with deregulation. You probably will see banks start to increase their dividends more in the subsequent years.
Fortunately for us, inflation doesn't impact a lot of what we spend money on. We look at cash positions, say we can afford it or we can't.
Okay.
The one that comes up with questions is the cemetery perpetual care expenses, which we have to pay every year.
Right.
We'll be looking at that later on in the agenda.
Okay.
But other than that, sounds like we're still in pretty solid shape.
I got a question.
Yes.
I think I know the answer, but I'll ask. When you calculate the equity yield, is that based on the market value of securities at a given time, or is that based on the acquisition cost?
It's based on current market value.
So our yield, if we purchase these portfolio earlier at a lesser price,
It's higher than
is
what.
higher
Yeah.
than what you report here.
Yeah.
Yeah.
The correct way to show it, we're not showing you book yield per se, we're showing you current yield, which is based on, it's more of a current approximation of the yield of the portfolio.
But from a standpoint of the people in the audience, the real yield is more because
much
we
higher.
acquired the securities at a lower value.
Correct, yes. And you've also had the continued dividend plus the appreciation of the underlying security as well.
Follow up, anything else? Kathy? Liz? Paul?
Not yet.
Okay. Lindsay, I guess it's your turn.
Great. So summary, first of all, for portfolio performance, just going to read a little bit off the slide here. The year-to-date equity returns have outperformed the NASDAQ index return of 16.73%. So for common income, we're looking at 17.88%, principal 17.97%, and scholarship 16.9%. So strong returns across the board there. Bond returns have seen outperformance because of the higher exposure to corporate bonds, which are high quality. And then for the different capital reserve portfolios, we are positioning them for liquidity needs based on the amount of liquidity that's been conveyed by yourselves. So they are laddered using a 1 to 3 year ladder of maturities, and all portfolio durations are approximately in the 1 year bucket.
And just to highlight for the people watching, it's not the actual NASDAQ index that we're comparing the performance to, it's the NASDAQ US Broad Dividend Achievers Index, so it's more of an income focused. The NASDAQ kind of throws people off. It's not a tech index. It's an actual index of dividend paying stocks.
Yes.
Thank you. I had a question about the capital reserve funds. If I read the charts correctly, the return for the town capital reserve fund was about 6%, about 5% for the MVD, and 4% for the school.
Mm-hmm.
That's a reverse of what we had a year ago this time, when the town was kind of in the middle. And we thought that was partially because the town was moving more money in and out of the capital reserve funds than the other two bodies. And I don't think their practices have changed, but I'm just curious why we're making that 654 relationship when, for example, the school rarely digs into their capital reserve funds, and of course they don't have very much. Any thought process behind why we're getting I would call a percentage point significant difference?
The capital reserve fund for the municipal, which is the one that I have pulled up on the screen right now, does have more liquidity, so there is more rolling off compared to the school fund, which is much smaller, and MVD, which is also larger, but it has a little bit less turnover within the portfolio. So we are able to ladder it out, get a little bit more liquidity in the market from that perspective. I think we're targeting right around that 1 million to 1.25 million in liquidity there. So with the maturities as well as the inflows that we get from the town on a regular basis, there is a lot more movement, I would say, within the municipal fund compared to the other two that allow for some increased volume.
So basically what you're saying is that we're able to invest at higher yields as those payments or those sources of capital came into the portfolio. So
Yep.
be able to put higher yields into the
Longer
portfolio.
duration?
We're laddering out 1 to 3, so we'll probably put a little more of an emphasis on that 3-year. Rates were higher, so getting, in that 3-year, you're getting over 5%.
Yeah.
So that's why you're seeing those returns.
So you're saying moving forward, we'd have a longer ladder?
Well, they're all in that 1 to 3-year ladder. It just,
Well, Lindsay
Yeah.
just said a year, a little bit over a year.
that's on average. So
On average.
That's the
Okay.
duration.
So would we be trending to 18 months or 24 months?
Not necessarily, because things are, as we move forward into the future, existing maturities within the portfolio become shorter. So with the increased volume within the municipal portfolio, we're able to go further out on a more frequent basis and take advantage of the high yields compared to, for example, the school portfolio. Let me just pull it up. The school district portfolio, which is 1.2 million, compared to the municipal portfolio, which is 8 million. So just given the frequency of maturities, there's a little bit more activity within the municipal portfolio compared to something like the school portfolio.
Okay.
But I think what Chris is saying is, the school portfolio, they don't draw on the school portfolio as much, so you could go longer durations in the school portfolio. Isn't that kind of what you're thinking, Chris?
That's my thought process, yeah.
Yeah.
Yeah, we can do that. As the next maturity hits the portfolio, we could roll it out.
I mean, you
towards
guys have to determine if it's advantageous. I mean, we're not trying to tell you how to
Well,
manage it. I mean, if it's advantageous to go a little longer and get, some more yield, then I would think,
It wasn't over the last 12 to 18 months because of the inversion of the curve. Now with a steeper yield curve, it probably is a little more advantageous to move out to school district. If the funds aren't needed, we can probably get a better yield than staying short.
Yep.
Okay, thank you. From the town's point of view, we normally get a cash infusion late in December. Paul, I don't know if you have an inkling of what that's gonna be this year or not. Are we too early?
Yeah, just a little bit too early.
We know we'll get $1 million anyway.
Yep.
And
And then you
they'll ask for it
typically-
back in June.
Right. And it's typically around that $2 million mark that you need in June. So that's another point with the municipal portfolio that we really do try to plan around that to make sure that there are maturities happening so that you have enough liquidity at June. But then with the inflow that comes in December, that we're able to go out further along the curve and invest it. So having that consistent turnover within the portfolio makes it a little bit more active compared to something like school.
Paul?
Thank you. Yeah, the tax bills just went out last week. So they were dated Monday or Tuesday, and they'll be due the third week of December. So at that point, we'll know better when we can execute those transfers.
Great.
Yeah, I hear you made a lot of people really happy about the new tax bill.
I will not venture an opinion on that.
Just put on your bulletproof vest. Okay, I'm sorry to interrupt. Did you want to go through the rest of the charts and whatever else?
Yes,
to
yeah, absolutely.
Keep us up to date?
Yep. So starting, am I on the right page? Yes. So starting on page 14, which is the Capital Reserve Fund Agency for the municipality. The 1-year performance here is 6.15%. You can see some strong performance from the fixed income sleeve, which is the majority of the funds, up 6.2%. So outperforming relative to the short-term 1 to 3 year U.S. government bond ladder. And just as a reminder, all the capital reserve funds are invested in a mixture of treasuries and CDs. The next one we're looking at is on page 16. This is the Village District Water. Current market value is $7.7 million. The 1 year the 1 year return for this portfolio is 5.3%. Fixed income returning 5.23% and cash returning 5.25%. So relatively equal there. Following portfolios on page 18. This is the principal common trust funds. So for the 1 year number here, we're looking at 24.11% versus the benchmark, which was up 22.4%. So some nice outperformance there. On the fixed income side, a return of 9.7% versus 8.2% for the benchmark. So that is representative of the increased corporate exposure that we talked about a little bit earlier on. And then on the equity side, the portfolio is up 32.3% relative to the NASDAQ US Broad Dividend Achievers Index, which was up 30.3% during that same time frame.
How do you protect that gain?
Looking at the portfolio, taking repositioning where we think that valuations might be a little bit extended. So taking down some winners, repositioning based on what we're seeing in the market as well as what the analyst team is conveying to us about valuation. So really trying to make sure that we're right-sizing positions there.
And this is the portfolio that allows for 10 to 15% in growth stocks. And we did add a few growth stocks earlier this year. The biggest winner was Arista Networks, but we added Meta, Amazon, and Salesforce, and those have underperformed the broader market. Still like the long term, especially with Amazon, the long-term growth prospects. So when you see the comparison between the principal and the income portfolio had a little bit of a better return, just because some of the growthier stock or the growth stocks that we added to this portfolio underperformed a little bit. So that's a little. So we added growth when they've actually underperformed a little bit, but we still like the long-term prospects for the stocks that are in the portfolio.
Anything else?
We do have a couple more portfolios just to go through quickly. So looking at slide 20, this is the income portfolio, as Eric was just mentioning. So total return here for the 1 year is 23.1%. On the fixed income side, similarly 9.7% versus that 8.2%, and 32.09% for the equity return versus 30.3% for the U.S. Broad Dividend Achievers Index there as well. Moving on to the school district on page 22, total return here is 4.97%. This one does have a little bit more within the shorter term bucket, so within the 0 to 1 years to maturity. And that did return 5.2%, with the remainder in the fixed income, so longer than 1 year to maturity, returning a little over 3%. And then for scholarships, the 1 year total return is 22.9%, with fixed income returning 10.5% here. Equities returning 31.33%.
That's embarrassing.
So against the same benchmark, up 30.3% there. And then finally, we have the Barry Quimby Memorial Fund. The one-year performance here is 17.38%, fixed income up 8.5%, and equities up 29.15%. And that's versus the global equity benchmark, which is up 35%, which is a mixture between the S&P 500 and the MSCI ACWX US. And this is the smaller portfolio, which is managed through mutual funds.
And this portfolio does have it can't exceed 50% in stocks, and right now we're about 46.5. So we do have it coded in our systems. If it gets to 48%, we would have a conversation with you.
Yep.
So we're getting close, but not there yet.
Sounds good. Anything else anybody wants to talk about?
Generally speaking, what is the balance that you're looking at, like equities versus bonds and cash equivalents and all that sort of thing? You know, from a broad perspective.
So I'd say right now the three portfolios that have more in equity, so especially principal and income, we're about 70% in stocks, and then balance about 20. We run the cash, about 1.5% in cash, so the balance would be in fixed income. So we try to keep it near fully invested. And with principal cash, the income, especially for the principal portfolio, gets paid out. So we try to keep it near fully invested as we can. That's all within the policy limits.
For the other towns whose trustee funds you manage, any of them doing anything that's spectacular that we should know about?
I haven't heard of anything different. Most of them are following the same equity strategies that you are. I think for the most part, most of our clients have been extremely pleased with the performance, especially year to date. Again, over the last 24 months since the bottom in 2022, the S&P is up over 60%. So it's been a really good market, and these portfolios have had some sizable appreciation. We've had some pretty good growth. I think in general, clients are, especially the trustees.
You're not anticipating a pullback, though, huh?
At some point we will. We're not seeing it in the near term. Valuations are expensive just on like the top 10 stocks, not on the remaining 490 or trading in a more reasonable range. So you've seen we expect volatility will probably increase more in 2025. But we're comfortable as a firm overall. Our asset allocations were about a 2.5% overweight to equities. Yesterday, the asset allocation team met, which I'm a member of, and we're maintaining our targets for now, with the caveat that we may want to go more towards neutral at some point in 25 if we see something on the horizon that we're not comfortable with. But right now we are. And, for what I mentioned earlier, looking at the market as a whole as we head towards, what is a slowdown but not a recession, and stocks typically do well in that scenario. And again, if you're now bringing a lot of that pro-growth America First agenda, we still need to see how that's going to play out over the next, 6 to 12 months. But that could also be a nice, tailwind towards growth in the U.S. market. So as a firm, we're overweight domestic versus international markets. We're about a 5% underweight. Your portfolios don't have much international exposure, but in general, we're overweight domestic, underweight international.
What are those top 10 stocks?
So it's changed because Tesla fell out, but since the election, they're back in. They're up 35% since the election. So you're looking at NVIDIA, Amazon, Apple, Google, Netflix, Facebook. Those are what have been traditionally what they call the Mag 7.
Mm-hmm. And where are you on Bitcoin?
We do not invest in Bitcoin. we like hard currencies that you can actually see versus something out in the crypto world.
Are you seeing anybody looking at that?
We get asked the question a lot.
Yeah.
It's something that we're not looking to invest in. If people want to do it on their side accounts at Fidelity, they're more than welcome to, but there's no real investment merit in our opinion to it.
I see a lot of, like, the Mag 7 or those 10 you listed, there's a lot of momentum related to those stocks. I mean, the intrinsic value, I mean, when you have a company like NVIDIA and its market value is $3.5 trillion, and a year and a half ago its market value was $1 trillion,
Mm-hmm.
that kind of scares me.
It scares us as well, but
I mean, I know a little bit about that industry, and, you know, competition will come along, and they won't be able to price to the level that they can price right now. Pretty much a monopoly right now. So, I mean, how do you guys think about I mean, to me, the market's turned into a momentum market, or, you know, versus a market based on fundamentals.
we would agree with that. And fundamentals, so a company like Tesla, fundamentally it's trading at 80 times earnings. Wouldn't buy it, but it's 2.5% weight of the S&P 500. So not owning Tesla becomes a tracking error risk to your portfolio.
Mm-hmm.
We don't own Tesla in your portfolios or in the firm yet. Same thing with NVIDIA. We don't own it in your portfolio. It's volatile. But for portfolios where it's held, we actually sold it in 22 and started to buy it back late 23, in 23, realizing that this has a lot of growth to it. But a company that is basically tripled its market cap in 2 years, it can't keep that toward growth going. At some point, it's going to have a pullback. But there's other companies that where we like analog devices. We own AMD. We bought KLA Corp. So there's other areas that we're focusing on as well, not just the pure. We do have in other portfolios, growth strategies, a allocation to NVIDIA. And if you look at over the last 5 years, the stock's up 2,000%. So you start looking at returns versus benchmarks, it always becomes a risk of not owning it in your portfolio. But you can see from your, not owning it.
I'm just concerned with the lemming syndrome.
Mm-hmm.
And
No, we agree.
it's portfolio managers, they have to, when people who invest or have people managing their money, and they say, well, why don't we own NVIDIA? So the portfolio managers have pressure to own NVIDIA because, it's the hot one right now. But, historically, the lemming syndrome, comes into play, and all of a sudden, things go the wrong direction. I mean, maybe that's gonna happen with crypto, I don't know. But crypto's gone up since the election, 25 or 30% or something crazy like that?
Yeah, exactly.
With that in mind, I'm going to say it was a different printer, but we used to get our reports in a portrait instead of a landscape. And whoever did that set of reports had a nice secondary pie chart of sector analysis. And although we list things on the MS-10 by individual stocks in sectors, we don't get that analysis. And I missed that.
We'll include that.
Next time you get a new
Include
printer,
that.
let me know. But the backside of that is, my recollection in 2016, 2017 was, if you were invested, you were gonna make money, and you didn't have to be real discretionary about what you bought. But now, with the volatility that we're looking at, would you move emphasis from one sector to another?
We're looking at probably trimming some of our technology winners and moving more towards defensive sectors or more cyclicality to the portfolio. Be industrials and financials will probably be areas that we're focusing on. Probably not doing much in the consumer space. Valuations there look extremely expensive. You already saw Target, had a lower guidance, Target had a miss, so that area doesn't look extremely attractive to us on a valuation basis. On a fundamentals, we still like finance an area that we're looking to increase our exposures to, especially with the re-steepening of the curve. You probably saw Q2, Q3 be the trough of, lower earnings. You probably will see earnings continue to increase from the banking sector. So that's an area we're probably looking to take profits from some of the longer-term winners in the portfolio and repositioning into other sectors that we, adding a little more defensiveness to the portfolio going forward. We think, there's still opportunities for growth, but, you could also see a scenario in 2025 that the market is down because of driven by the top 10 stocks. But your portfolio, other portfolios would be positive because you're not as heavily invested in those top 10. So that's the scenario that could play out as well in future years, where the market as a whole could be down, but portfolios that aren't heavily invested in the Mag 7 or the top 10 can have positive returns.
Yeah.
And that's what I was talking to. I'm sorry. Go ahead.
I was just going to add, part of what our analyst team really focuses on is the bottoms-up analysis. So really focusing on fundamentals within each individual company. So looking at, outside of the top 10 stocks within the S&P 500 that are a little bit more cheaply valued or relatively attractive from a valuation perspective, really doing some deep dive research on those to try and find areas which haven't run as much that we believe are going to be performers over the next few years. So doing the bottoms-up analysis and doing, modeling and deep dive research into different sectors to do all of that research.
You mentioned industrials. Is there any concern that with the new administration's we talked about this pro-America approach, that there might be a hit there next year?
Well, I think the approach would be less of an emphasis on the electrification of vehicles, so I think there'd be a little more of a shift there. One of the companies we've owned is Eaton, which we have trimmed, which had a lot of emphasis on green energy or green power. So you're starting to see some of those stocks have already started to trade off a little bit, post the election, as more emphasis will probably be on internal combustion versus the electric or the electrification of the grid is what was the current administration. So I think you'll see a little bit of a different approach there.
As the green emphasis changes a little bit, we're hearing more about, I'm going to call them private nuclear plants, mostly to feed computer-based operations. Is there anybody that's shining out in that area? This is getting away from our portfolio, but just curious on your thoughts.
I haven't heard anything.
I haven't either.
Yeah. Can follow up with you if you see if our analysts have anything that's. I know Amazon has talked about doing something along those lines, just to power their infrastructure, so to speak.
Microsoft as well.
Yeah.
Yeah, I hear Microsoft, but I think
3 Mile
Microsoft's,
Island or
Yep.
something like that?
yeah,
Yeah.
I think Microsoft's been pretty sleepy in the last couple of years, to be honest, compared to some of the other things that get all the publicity.
What about a company like Pfizer? 6.2 or 3% yield, totally beaten up. I mean, we're not talking about a company that's gonna go bankrupt. What do you guys think about a company like that?
It's an area we've looked at, but I think on a valuation basis, it sort of looks like a value trap. You're going to clip that 6% dividend, but you may be down 20%. So you're not on a total return basis. You'll have a negative return. The growth. They had a bounce coming from the pandemic, and
Well, they were $60 at the peak of the pandemic.
Mm-hmm.
Yeah, and they're like 40 now.
No, they're like 24.
Oh, is that right?
Yeah,
I don't
they've
follow them that close.
Yeah, they've been crushed as you know, there's less, people aren't really going for the vaccines, for the COVID vaccines anymore, you know.
But they do so much more than COVID vaccines.
They're very involved, you know, especially with that mRNA for cancer research. You know, we've focused more on other stocks versus Pfizer. It's a name we owned decades ago. When I started at Cambridge Trust 20 years ago, it's a name that we probably held and used it as a source of funds for other opportunities in the portfolio. But, you know, our healthcare analyst keeps looking at ideas, Pfizer has not been on the forefront.
Anybody else? Okay, well, I'm going to say thank you very much. If you have an opportunity to get sector analysis added into our reports, that's fine. It's not an urgent issue, but just, I like pie charts.
With Thanksgiving coming up.
There you go.
Pies up.
Never know whether to buy apple or pecan pie. Shall we move on?
I think so.
Thank you very much.
Thank you for everything, and have a nice Thanksgiving, Christmas, and holiday, or whatever you want to say. Thank you for the donuts again.
All again, please take them back to the office and share whatever's left over.
Sounds good. Thank you.
Thank you. Have a great holiday.
Yeah.
Thank
Take
you, you
care,
too.
Eric.
See you next year.
See you, Lisa.
So the next item on the agenda is Watkins Forest. And we passed the comments that we got from Eric Radloff. And I don't think there's too much to say on that yet. But I did have conversations or emails with the MVD about the Mitchell Street parcel, and they say they have no plans to do anything in the foreseeable future. It's just backup property, and they think they've maybe done some test wells and that type of stuff, but no development. The question was coming up on that parcel, the Mitchell Forest, Mitchell Street Woods, because we need to access that through there to get to our parcel to do any kind of a harvest. And I think that's controlled by the Conservation Commission. I sent them emails to the chairman's personal email, and I sent emails to their online email connection, and I have not heard back yet. Not that there's a rush, but if we get in front of town meeting, we'd like to have that information in hand. And that brings us to item number 3 on this topic, which is harvest. And it looks like we're at a point now where we were not 5 years ago, but we're at a point now where a harvest is reasonable. And it probably wouldn't occur until about this time next year, or maybe even another 3 or 4 months after that. But in order to do it, we have to go to town meeting in March. And the timeline for that is to go to the town council mid-January. I don't know exactly what their meeting dates are. Do you offhand know? Will they be first and third Thursdays in January?
I actually had them up here. So January is, there it is, the 8th and 9th. The 8th would be probably, I'm guessing that's a Wednesday. I don't have my phone in front
That's
of me.
probably a budget.
That's probably a Wednesday, and then they have their regular meeting on the Thursday, the 9th. So they'll be talking budget on the 8th.
Okay. And the likelihood is our meeting is January 17th. So that's late for that particular agenda item.
There's another meeting on the 15th. That's also a budget meeting. And then there have a meeting on the 22nd and the regular council meeting on the 23rd.
Okay. So if we talk about this on the January 17th meeting, we'd be behind the curve on making decisions, getting information into them in a timely manner. So I think the issue in my mind from the calendar point of view, since we don't meet in December, is to decide if we want to go to town meeting in March and ask for a harvest, permission to do a harvest. And I think even if town meeting votes to, I think it's an allowance motion, or we can phrase it that way, so that if we decide a year from today that the harvest does not make sense, we're not forced into doing it. But I think if we want to move forward in that next 12, 14-month time frame, we should probably consider today. Does anybody have any thoughts in that direction?
I'm just curious. I'm sorry I wasn't able to go to the walk, but I'm curious, two things. One is, what's the market, I mean, what's the pricing looking like, or we don't know until a year from now? And then the second thing is, if we're talking a harvest, are we talking doing this just is it marginal that we do a harvest, or is the wood, the trees, are they really mature to the point where it makes a lot of sense to do a harvest? I don't know. I mean, I wasn't on the walk, and I'm just wanting to, get some
You want to say
feedback on
something,
it.
Kathy?
Yeah, I mean, it seemed that it wasn't so much mature trees ready for harvest as much as it was clearing out some stuff that was impeding the growth of trees that later on will be more productive.
Yeah, it was like, they were saying it was a
There's a
two-phase,
two-pronged
right, so
issue.
removing the larger trees, it would stimulate
Well, I
the
read
growth.
something, there was some
Yeah.
invasive species or
Right, that
whatever.
was,
Yeah.
that was along the
In one of the,
road,
not Lawrence Road, the other one had invasive species?
yeah.
They
Sounds
all
like they
have,
both did.
it's something that we just manage, it's not something that we're gonna get rid of.
I think
So-
manage is the
But-
key word there. That
Mm-hmm.
two things. One is the invasive species is primarily on land that we don't own.
Right.
But we would drive through that road or trail, whatever, path, to access our property. Now, we have another access on Profile Drive, but it's never been cleared. It's really not a good access point. It's only a 40-foot right-of-way. But going back and forth through the other Mitchell Woods tends to, or has a tendency to spread the invasive species. So that's why we wanted to talk with the Conservation Commission and see if they're gonna do anything, or if there's a methodology to control the invasives so that we can go in and do what we're in need of doing. And I think the money or the profit from the harvest goes into the Watkins Forest Income Fund for reinvestment. But it's as much a matter of forest management as it is looking for a specific profit level. So for example, when we looked at a cut in 2019 because forest products were expensive during COVID, the stump value of the product was not any different, and the large expense for product at the after it comes out of the mill was based more on transportation and handling costs than it was the value of the stock itself. So I think we're still in that situation a little bit, but in terms of 50 or 100-year management of the forest, the harvest is one, to make a little bit of money, and two, to manage it for another cut 25 or 30 years from now. remember Dan Sear going out, the first time I went out with him was probably 1990. And he said, you know, basically, a forester doesn't look at this stuff for today or tomorrow or his own generation or his children's generation. He's looking at stuff for his grandchildren. And I think that's a thought process that underlies some of this thought about cutting or not cutting, is to improve the overall forest as opposed to, or in addition to, having some income. Anybody else want to say anything? Or make a motion?
My only other concern, and I know that this probably isn't our problem, but, you know, I don't have a sense of the cost for the Conservation Commission to manage the invasives. And I don't, you know, I know nothing about what they have for resources allocated for invasive species, so, you know, I'm concerned that we haven't heard back from them on this. I know that them taking care of that, if it's if us harvesting is contingent on them having funding to be able to manage this, I think, are we putting the chicken before the egg here? Or vice versa, you know?
Understood. Conservation Commission gets a large part of its, I think they have some funds in general government in the budget,
Mm-hmm.
but they also get funding from land use change tax. And when you take money or take property out of current use, there's a tax on that. And they get, I'm not sure if it's all of the profit, but they get that tax and that funds their,
Right, they have funding. I mean,
Their
I don't know if they get
operations
grants
and-
for this type of thing too,
Yeah.
but, you know. They have time, it sounds like, to manage it before we would get to a harvest, is what I heard. I
right.
think, I don't know how long it would take to manage this, but,
Well, the other side of it is, and this is why I'm disappointed we haven't heard back from them, but we've got plenty of time. If we pass the warrant article in March, that doesn't force us to cut,
right,
but it does allow us to go through that process and work with them. If they want to do forest management on things that they control, my understanding, you're on the Conservation Commission, right?
I'm not on the commission, I'm on a subcommittee.
Subcommittee, okay. My impression is they can go ahead and manage stuff anytime they want. And so if it's just a matter of some management on their property, they can do a harvest if it's appropriate, and their woods may be, you know, they're 50 feet away from our woods, may be appropriate for a combined harvest, but they can certainly go in and do management at any time. So,
Okay. How do we do this? We want to make a motion to go before the town council in January to approve a harvest?
to put the warrant, put an article on the town warrant for town meeting.
Put an article on the warrant for
Town meeting.
town meeting
Yeah.
in January?
Well, town meeting's in March,
March.
but you have to do it in January because there's public notice timeframes and that kind of stuff, lead times.
Okay, hold on. I'm a little tired this morning. Make a motion to get an article on the warrant for the March meeting to approve a harvest in the future. Is that what we're doing here?
Yep.
Okay, here, I said it.
Second.
Any further discussion?
So you were concerned that any warrant article we put to town meeting would require that we do something within a certain time frame. Do we have to have some
I don't think it
timeframe
requires us.
in
I
the
think
warrant
it,
article?
I think it allows us to do something.
Allows us, but it doesn't require us.
Right.
Okay.
And we could certainly get to town meeting in March and say, you know, this isn't gonna work, everybody vote no.
Pull it, yeah.
I don't think it'll be a contentious item.
No, no. All in favor, signify by saying aye.
Aye.
300.
Mr. Chair,
Yes, sir.
may I address the audit follow-up? I have to get downstairs to do back on the CIP.
Go for it.
Okay, thank you very much. So we're still wrapping up a couple of loose ends on the audit. So far, all indications are that the town is in a very healthy position financially. The town manager, Mr. McCallie, did share that last night. We have a healthy fund balance. We're still working on, I think there's 2 items on our punch list to get to the auditors. One is the actuarial on post-employment benefits, which we're just waiting to hear back with their final report. The school just forwarded their information to that same actuary. So the hope is that before we meet in January, we'll have a signed, sealed, and executed audit.
Great.
Very good. And nothing that they need from us.
Nothing. Nope. They've got everything they need from trustees.
That's the big question.
Yes.
Okay, thank you very much, Paul.
Thank you.
Okay, the next item is Last Rest Cemetery. And we did receive a bill from them. I think I forwarded it to everybody.
14,000 and change. Is that what it was?
No, I think it was, I should, let me see if I have.
$14,479.53.
Thank you, yes.
Last chance for a donut?
Go ahead.
I'm gonna grab one.
Yeah, please.
I've been unloading trees.
Give me that number again, 14.
$14,479.53.
I thought I wrote that down to put it in the agenda, but I must have left it out.
I'll make a motion to approve $14,479.53 for Last Rest Cemetery.
Second.
Any further discussion? I will point out that and I talked to Paul McKelly about this yesterday on a coincidental run-in. They did not differentiate this grave from that grave in terms of how much effort it takes to maintain one versus another. They are still going back to their service company, landscaping company, to discuss that further. But the price went up about 70 cents, which is about 8% compared to last year. So that's probably within reason for other things going on in the world. The other thought that came to mind as we looked at the numbers is out of all of the graves in plot or section A, B, C, which are the ones along Babusick Lake Road, those are the ones that require the higher care. And our funding is dominant in those areas. However, we haven't received any money for permanent or perpetual care since 1975. So the back end of the cemetery where things are cheaper doesn't impact us at all because we're just not involved in those graves. So what they're looking at where we are is probably pretty stable. We'll know a year from now. So I'm not too worried about it. And I would vote in favor of the motion to pay the bill and continue having conversations with them just to everybody up on top of any issues that may arise.
Not to beat a dead horse on this, but, I mean, 'cause it doesn't seem like it's a whole that big an amount of money, but what did you base the 14,000 on? Because their spreadsheets, their backup spreadsheets seem to total somewhere in the neighborhood of 10, and I wasn't sure what the basis was that, we were using? Is it a certain dollar amount per grave and then just apply that across the board?
Pretty much. I
Yeah, okay.
didn't get it this year. They usually give us a little listing of workers' comp, landscaper, half a dozen other cost items.
Yeah.
Total it up, divide by 278 graves or 6,000 graves, whatever the number happens to be, and then give us that number for the 270 graves that we are funding. So that's how they come up with that number, but it's based on their total expenses. So in some respects, we appear, in my mind, to benefit a little bit from the new section down back. It doesn't cost them as much to care for, but I don't know that that's a major impact. And they're still operating off of new income, new sales, to subsidize their operations, because a lot of the graves that are in the old section next to the road don't have a specific fund per grave, and so they're absorbing it within other operations. And are we differentiating that out? Probably not. And in my mind, it may not be productive to try and do a detailed analysis of per grave by age and site and so forth. I think certainly the landscaper doesn't come along with a clipboard and say, okay, I'm doing number 122 now. Start the clock watch. It just doesn't work that way. Anything else? All in favor?
Aye.
Aye. School board response. I did get an email from Laurie Peters, who's the chairman of the school board, who said they are planning, Amy Doyle. Laurie Peters sent me one, said we'll try and get some of this stuff on the agenda, but I haven't heard from them in that respect. But Amy Doyle, who's the curriculum superintendent, did say they've talked to a facilitator, and they've got somebody who's going to run the prize speaking contest, and that will probably be in early June. And I wrote back and said, what about Lego? I haven't had a response on Lego. And that concerns me a little bit because end of December, 45 days from now, we usually get another addition to the Lego fund from the Watson Foundation. And I suppose the way that's been set up, if the Watson Foundation wanted to change the use of the Lego money into scholarship money or something, they can do that at a future date. So I'm not worried about it, but it's just something we have to follow along with. Okay, next item is authorization to pay scholarships. Usually in December, we get some beginning of scholarship requests coming in for the scholarships that were awarded last May, because they're due for the second semester. And so we pre-authorize paying those scholarships so that we can pay the student bills and not have them hung up with their purser's office and hold it off until January. So that's, I'm looking for a pre-authorization to pay the scholarships as they come in for the amounts that we agreed on last spring.
I'll make a motion that we pay respective scholarships as they arrive in accordance with what we voted on previously.
Okay,
A second.
all in favor?
Aye.
3-0-0. I haven't actually seen it in the mailbox yet, but I anticipate the Bear Christensen Fund will get a donation of $12,000. We're on the agenda for the town council for December 5th for their public hearing on that, assuming it will come in, just so you know.
That's very nice.
Anybody,
That'll
anybody wants to come to that hearing, you're welcome.
allow us to give more scholarships, right? For,
And whatever Matt asks for.
right,
It's all aimed at parks and recreation and youth. One of the things that is in his background, if you will, is improved beach access. So he's got, I think it's $80,000 in the budget, in the capital improvement plan, to improve the beach for ADA access. And one of the things he's looking at there is an ADA beach wheelchair, which has big balloon tires and can go into the lake and out and so forth. And that runs, I don't know, $3,500, $4,000. So that would be something appropriate to this fund as well, if he asks for that. I also suggested to him that if they wanted to do a kids concert or some other in the summer concert series or other youth activities, that we would listen to his proposals, just to get some flexibility into his thinking. But we don't have any specifics to act on today.
very nice.
But I think that will bring us, by the end of the year, we'll be up to about 100,000 total in the fund, and about 20,000 of that will be expendable. So that'll be a boost for him to continue the programs that we already support anyway. MVD, this came in late, which is why the agenda was amended. They want $124,320 to pay for a truck that they've already got on the books.
That's not a,
And that would come out of the Equipment and Facilities Fund.
Didn't we just do this?
Yeah, they're buying stuff all the time. It seems like, yes, we just did it because with the town, we do it once in June. With the MVD, we do it as the bills come in.
I motion we pay $124,320 for a truck for the Merrimack Village District.
Okay?
I'll second.
So it's a truck and some specialized equipment that goes on the truck, as I understand it.
Yeah, it's gotta be more than a truck.
Yeah. Yeah, I looked at the invoice, and there are two vendors involved, one for the truck and one for outfitting it. Any further discussion? All in favor signify by saying aye.
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 Future dates. It's okay, it's just. We don't meet in December traditionally. If there's an emergency, I suppose we could, but I never have. January 17th seemed to be the next reasonable, regular date. Anybody traveling?
I will not be around on January 17th. I could do it remotely, or I don't know if Kathy will be here,
I should still be around.
Okay,
so we're probably covered.
very good. So I'll leave it as January 17th and then February 21st. Anybody know their schedule at that time frame?
I
I'll be
think
here.
I'm good for that.
Not sure,
Yeah,
maybe.
Key West is calling.
It is, we'll see.
I should be here. I should be here in February.
Okay. Anything else that should properly come before the trustees board?
Motion to adjourn.
Congratulations, Bill, on getting all the Rotary Christmas trees
Yeah,
unloaded and ready for sale on November 30th.
Excellent.
Nice
And-
plug there.
Went well.
thank you for taking a load off Steve.
They smell.
I can smell
Good.
it.
Okay, so I've got 10:12. We are adjourned.